you've all been waiting for it. The giant Meet Kevin flip-flop. What a day. The stock market, S&P 500, 1.5% over all-time highs. Tesla up nearly 7%. Jim Cramer poops on Palantir so badly yesterday, calling it a barometer of momentum, a meme stock, a cult stock, and he's not even sure if it's actually a stock. I tweeted about this on X, by the way, posted about it. And Palantir's up. Everything's going up. The market is in full-fledged euphoria mode, and everybody's been waiting for Kevin to say, this is it. This is the fundamental data we have been looking for that says this is it. We are going all in, baby. We are going back to being bulls. Well, this morning, as many, and we're going to talk about it here, but this morning, as many of you over, frankly, somewhere around 1,500 or 2,000 of you that already know about this, thank you so much for joining me this morning in our course member live stream. Those of you, we already went through a 48-minute custom course member live on exactly positioning and valuations and thoughts. And remember, we still got that flash sale going on until noon. So if you want to be part of that, you got a few hours left here to hop in on that flash sale. Check that out by going to meetkevin.com. And you can always, for the rest of forever, get those course member live streams. So if in 8 years you're like, I wonder what Kevin's 48-minute positioning update is, you too could see it and see my thesis and rationale behind everything. But for now, we've got to talk about going bullish because, frankly, right now what's happening in markets is markets are saying, maybe we need to take profit on our recession hedges. You saw gold move down a little bit. You saw bonds move down a little bit, which are generally considered recession hedges. And now you're seeing recession, recovery plays, which are generally considered risk assets. Right? Think about when the Federal Reserve capitulates like they did at the bottom of the market in 2009, at the bottom of the market in March of 2003, at the bottom of the market, in the late 80s. When the Fed capitulates, it's usually at the bottom of the market and it's time to go all in because risk assets moon. NASDAQ goes to all-time highs. Small caps skyrocket, crypto-related assets, if they existed back then, would probably go to all-time highs. Fed capitulation is a great time to go all in. And so a lot of folks are wondering, Kevin, is this a Fed capitulation? And we have to understand the fundamentals of this, and I think history is an interesting guide. So first of all, right now, we are getting a turning point in the Fed, as Jerome Powell likes to call it, a recalibration. But is this a Federal Reserve capitulation? Is this the Fed saying, hey, we're just going to go all in and bail out markets? No. What we actually got was the Federal Reserve saying, hey, everything's fine. We're just going to try to front run some labor market weakening. Interesting. So to front run labor market weakening, what you're going to do is you're going to try to drive yields down, but what you in effect did is you actually drove yields up because people are covering their recession hedges and yields went up. So now all of a sudden, when you look at the ADP employment report and you find out which sector of the labor market is the weakest and you realize it's small businesses that usually aren't public, you go, oh, higher yields actually hurts the weakest part of the labor market and actually exacerbates the problem. So the Fed didn't actually bail anything out yesterday. The Fed certainly didn't capitulate. If anything, they actually accomplished literally the opposite of what they're trying to accomplish. They have just tightened financial conditions for credit cards, for loans on Teslas, for financing on solar panels, for the 30-year mortgage. All of those got more expensive. So think about that, how weird this is for a moment. The Fed cuts rates with a surprise 50, and every rate that people are exposed to gets more expensive. People are like, oh, it's the start of the rate cut cycle. Yay, Tesla's going to go to the moon. And it's true, Tesla's up 6.5 or whatever % today. But wait a minute, rates just got more expensive. Expenses just went up at Tesla for them to pay those buy downs for you. The start of the rate cut cycle so far is doing exactly the opposite of what we would expect. This is not a Fed capitulation. This is a turning point in Fed policy. But fundamentally, nothing has changed. We are still in an environment with weaker than historical ISM services. We, in non-recessionary times, we should not be this weak on ISM services. We are still in an environment where job openings and the job market is rapidly slowing. And even Jerome Powell himself acknowledged that, there's going to be a lag to our 50 basis point cut. Okay, great. So in other words, not only are yields going up right now, but your rescuing of this jobs market isn't really happening yet. Okay, great. So now all of a sudden we look and go, okay, so we're not actually getting near-term support from the Federal Reserve for undoing a recession. So what fundamental data did we get that would indicate maybe no recession? Well, maybe GDP, right? GDP is obviously a good predictor, but it's also not part of the Federal Reserve's mandate. The Federal Reserve's mandate is around jobs and inflation. And if the Fed loses control on jobs, GDP rolls over second. It is not a leading indicator, it's a lagging indicator. And then, of course, layoff indications, which are rightfully still low right now, and probably go down as the stock market rises for larger cap companies, does help us move further away from a recession, right? Because as stock markets rise, you have less of being near a trigger point, so to speak, for layoffs, where valuations have collapsed so much that you have to lay off just to try to save the business. You're further away from that as the stock market hits all-time highs, but it doesn't mean that recessionary considerations that are still present have all of a sudden evaporated. And so this is fascinating because a lot of folks, they look at very simply and they go, oh, Kevin's been bearish, so Kevin must be getting smoked. And what's fascinating is my hedge, the underlying position that my hedge is exposed to is down like 1.5%. We talked a lot about positioning, repositioning changes, all of that in the Course Member Live this morning. Make sure you're part of that. But it's actually kind of remarkable because if you look at it, you're like, interesting. Usually when the market skyrockets, hedges get absolutely destroyed and smoked. And so I think there are really interesting ways not to be short the market that pay off disproportionately well if you go into a recession, but you don't want a recession, right? Recession is really bad for startups. All three of the startups I have, recession is really bad for. But what I'm looking at is I'm looking at fundamental data, temporary job hiring, real domestic investment spending, the rapidity of the steepening of the yield curve, which is now exacerbating, right? We're at like 13 basis points uninverted. And usually when you get to about 50, that's when you're really triggering that recessionary pain. You're looking for a recovery in private jobs and healthcare jobs. You're looking for a recovery in both of those. Those are still both collapsing, right? These are problems. Of course, we've got more data coming up, more jobs reports, more inflation reports. We've got Q3, Q4 earnings. We've got an election coming up. And so what's fascinating is looking back at history. History actually tells us that when the Federal Reserve goes for a 50, especially when it's unexpected, you get a near-term rally. Consider this for a moment. I want you to go back to 2007, 2008. Let's go to 2007. We cut interest rates 50 basis points on a surprise right about here, September 18th approximately. And you'll notice the NASDAQ actually rose an additional 11.5% from the interest rate cut of 50 to all-time highs. And after that 6-week rally that you got in the stock market, the market went into recession and proceeded to collapse by 54.5%. So then I go, well, wait a minute. Things are rallying. This is wonderful. This is excellent. It's time to go all in, isn't it? I mean, stocks are up, so everything must be good, right? And so I take out my recession sheet and I go, okay, cool. What's fundamentally changed? Well, if the Fed is reducing by 50, that should be bullish, because it should mean yields are going down and we're reducing the odds of recession. But wait a minute. Nothing's fundamentally changed. We still have the recessionary red flags, and oh damn, yields went up, which is more recessionary, not less recessionary. Well, that's unfortunate. So then you wonder, okay, well, what are the next catalysts? Well, you have Fed speak that could talk rates down, right? You could keep markets still elevated and you could talk rates down. Harker talks tomorrow at 2 p.m. Eastern time. Bostic Monday at 8. Goolsbee Monday at 10:15. Kashkari Monday at 1. Collins next Thursday at 9:10. Powell next Thursday at 9:20. Write these things down. Williams Thursday at 9:25 next Thursday. Next Thursday, Barr at 10:30. Next Thursday, Kashkari at 1. Next Friday, Collins at 9:30. And 2 Mondays from now at 1 p.m., you get Powell. Then you get the October 4th jobs report, the October 10th CPI report, the November 1st jobs report. Then you have the election. Then you have the November 13th CPI report. But because yields are actually rising right now, I actually have reduced my position on the bear bull scale. Yesterday I'm like, they went 50. This is bullish. So I went from, 3.5 to 3.6. Now I'm down to 3.4 because I'm like, bro, the market is doing the opposite in terms of yields of what it should be doing following this Fed move. And it's eerily similar to what happened during the last recession. Now remember, when the Fed starts with a 50 out of the last 21 rate cut cycles, you have a 50% chance of recession historically. And so, in my opinion, this is not the time to cut hedges. And I'm not saying that you should be all in on a hedge, right? We talked about my, $2.5 million trades this morning. Are they up? Are they down? Am I repositioning? Am I buying? What am I doing? We talked about all of that in the course of my live. Make sure you're part of that. Buy that the course before noon today, the flash sale ends. But remember, hedging isn't supposed to be your entire portfolio. It's not supposed to be the only thing that you have. Hedging is supposed to be something that, in the event of a tail risk, we call it in finance, in the event of a tail risk, where you fall into a recession, you have a disproportionate upside and hopefully a more limited downside. And for me, nothing has changed for me to say, oh, it's time to fully flip-flop and go bullish and buy stocks. If anything, valuations have gotten more dumb. Palantir is trading at a 4.5 peg. And while it's got the momentum and it can keep going, that is twice the valuation it should be. Tesla is trading at a 3 peg. That is nearly twice the valuation it should be. Trade Desk is trading closer to a 3 peg. Not that bad. It's actually not that heavily overvalued. And then like an Enphase or Ubiquity, those are actually still pretty decently valued. NVIDIA is actually decently valued as well, relative to some of these sort of earnings growth metrics. But I actually think this is an environment that is so eerily similar to 2007 that this idea of, oh, the stock market's up, it's time to flip bullish is just like without logic or reason, and is very dangerous. Of course, there's always the risk of biases or whatever. But I think that's why it's so important for everybody individually to evaluate, okay, what information is useful for my portfolio, right? And so if you want, go look at the 48-minute live stream we had this morning. But I'll give you a hint here. Am I flipping bullish because that's what everybody's asking me? No! This is bad. Like, I know I sound like a clown when the stock market is flying today, and I'm like, this is bad. I know that sounds stupid, but look at 2007. Okay, that's all I gotta say. I love y'all. We'll see you in the next one.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.